One question that people ask a lot is, how do I invest a lot of money, like $10,000 plus? Do I invest in real estate or do I invest in stocks? And I'm not here to argue whether one is better than the other. They each have their own pros and cons. The main factor that you need to consider is, what is your risk tolerance? And I'm not just talking about personality type. If you like to jump out of planes or drive fast cars, means you should have a high risk tolerance. I'm talking about an objective way to look at risk where you can figure out how to take the most appropriate amount of risk to make the most money as possible while eliminating the possibility of going broke. When you think about what your appropriate risk level is, what your risk tolerance is, there's a couple of things you want to consider. Number one is how much you make. Number two is how much you spend. And number three, the most important thing, is how much you have. Because if you think about it, it's actually really obvious. How much you can afford to lose depends on how much you have. For example, if a person has $10,000 that they want to invest, but their net worth is also $10,000, meaning that's everything that they have, versus another person that also wants to invest $10,000, but their net worth is $500,000, the person with $10,000 versus the person with $500,000, their risk tolerances are completely different, super different. If the person with $10,000 loses their investment, all their money, then it's financially and mentally devastating. They have to start all over again. Versus the person with $500,000, if he loses his investment, his $10,000, then yeah, that sucks. Nobody wants to lose that amount of money, but it only represents a small portion of their entire net worth. It's 2% of their net worth. Am I saying that the more money that you have, the higher net worth you have, the more risk that you can afford to take? Yes, I am saying that because that's generally true, but there's a second thing that you want to consider when it comes to your risk tolerance. And the second thing is, how close are you to retirement? I'm not just talking about age, I'm talking about how your net worth, how close are you to financial independence? Because the closer that you get to financial independence, the less risk you should take. So the person with a $500,000 net worth versus another person with $1.5 million net worth, I would argue that the person with a $500,000 net worth has a higher risk tolerance than the person with a $1.5 million net worth. Because the person with the $1.5 million net worth, he can retire on that amount of money. He doesn't have to take any additional risk anymore. So I created this graph over here, and on the y-axis I have your risk tolerance, and on the x-axis I have your net worth. So basically what I'm trying to illustrate here is that the higher your net worth, the more risk you can take until you get to a point where you can retire. I have my retirement number at $1.5 million. That's different based on who you are, what your lifestyle is. So that number just depends on you. And so I have it at $1.5 million. And at that point, you have to ramp down your risk and protect your financial independence, your retirement. And then if you start growing your net worth some more after that, you can take more risk as long as it doesn't endanger your retirement. And then at a certain point, if your net worth is comfortably higher than your financial independence number, then you could start thinking about whether or not you want to ramp down your risk and just focus on net worth preservation, or if you want to just keep your risk level moderately high and focus on making as much money as possible. It's kind of just up to you. For me, I'd rather just focus on net worth preservation and maybe pursue some opportunities that I find particularly financially rewarding or even mentally rewarding, but that's just me. Before I talk about what I think is low risk versus high risk, I want to talk about the relationship between risk and reward. There's generally a misconception when it comes to risk versus reward. Generally, people think that low risk equals low reward and high risk equals high reward. While that's generally true, because we live in a fairly efficient marketplace, there are such investments that are low risk and high reward. And it's basically your job as an investor to find investments that are low risk and high reward, while also preserving your net worth. Because there's also a difference between risk level when it comes to an investment itself and risk level when it comes to you personally. So for example, right? Let's say that there is an investment that has an 80% chance of doubling over the next year and a 20% chance of going to zero within the next year. That's technically a low risk, high return investment. But what if there's a catch where you have to invest 100% of your net worth into that investment in order to qualify for it? Now that is a high risk investment when it comes to yourself personally, because yeah, most of the time it will work out. 8% of the time it will work out and you will double your money. But the 20% of the time that it doesn't work out, it's financially devastating. And it's basically like playing Russian roulette with your financial well-being. So don't play Russian roulette with your financial well-being. All right, so the best strategy when starting out to maximize your return while minimizing your risk is to invest through tax advantage accounts like your 401k, your Roth IRA, and your HSA. And I'm not going to go into much detail of what these accounts do. I'm gonna talk about this further in a future video. But the best strategy that almost anyone has access to that can grow your wealth is to minimize your taxes. And that's what you are doing through investing through your tax advantage accounts. And I'm going to repeat this a lot in my future videos, and I've already said this a couple times in my past videos, but I only repeat this so many times because it's really important. The order in which you invest is as follows. First, you contribute to your employee-sponsored 401k up to the match. With money left over, you contribute to your Roth IRA up to the contribution limit. If you have money left over after that, you go back to your 401k and you contribute to your employee-sponsored 401k up to the limit. And then if you have money left over after that, you contribute to your HSA, your health spending account, up to the limit. Any money left over after that, you invest in your taxable regular brokerage. Within your 401k and probably your HSA, you probably only have the option to invest in index funds. And in your Roth IRA and your regular taxable account, you have the option to invest in index funds or individual stocks. In the beginning, I would recommend only investing in index funds until you gain some experience and feel comfortable trying to look for opportunities in individual stocks that provide low risk and high return. I would start off with large companies that offer a dividend because those companies are generally easier to analyze. Whether or not you are investing in large cap dividend companies or small cap growth companies, your job is still generally the same. You're looking for companies that are low risk and high return. So after you have your stock portfolio established, you can then start getting into real estate. And the best way that I recommend people get into real estate is through a house hack, which means that you can start off buying a duplex and living in one house, one of the units, and renting out the other unit. Or I think that the best way, the easiest way to get into a house hack is to find a single family house with a back house, and you can either live in the front house and rent out or Airbnb the back house, or better yet, live in the back house and rent out or Airbnb the front house. I recommend that everyone start with a house hack because first of all, you need a place to live anyways. So if something goes wrong, you're not really risking a lot of money. And secondly, you're on site 24/7 because you live there. So it's really easy to manage from that perspective. And it's easy to just get your feet wet to see if you even like real estate, to see if you want to pursue investing in real estate and buying a second property. If you do decide that you like real estate and you want to buy a second property, then you can go ahead and do so through leverage real estate. And when I say leverage real estate, all I'm meaning is that you borrow money in order to buy real estate, just like 99% of the people out there do. And the reason why I think leverage real estate is one of the more risky investments out there is because the act of borrowing money in order to invest just by nature makes the investment more risky. Because if you borrow money to invest and that investment ends up being a great investment, then you make a ton of money. But if you borrow money to invest and that investment becomes a bad investment, then you lose a ton of money. So it's kind of like what I said in the beginning. If you have a low net worth and you invest the majority of your money into something that is high risk, then you're basically playing Russian roulette with your money. So with your financial well-being. So Yeah, most of the time when you find a good investment and everything goes well, the market is favorable, then you make a lot of money. But the off chance that something goes wrong and the market crashes, then you basically are wiped out financially. So that's why I wouldn't recommend investing in real estate unless you already have a high net worth. And around the same risk level, I would say, is starting a side business. And the risk level depends on a lot of things, depends on the market, the type of business, how much you want to put into that business. But I also wouldn't recommend starting a side business, like a full-on business, not just a side hustle, unless you already have a high net worth, because that would allow you to take more risk and put you at advantage compared to your competitors. And as you get closer to your financial independence number, your retirement number, you should ramp down your risk by investing any additional money that you have into individual stocks, into index funds, and even non-leveraged real estate. So that's basically my risk to net worth model. Basically, it's just saying that the type of investment that you choose should be based on your net worth. So let me know if this makes sense to you, whether you agree or disagree. Happy to have the discussion. For my next video, I'm going to be talking in more detail about the tax advantaged accounts. If you want the YouTube algorithm to push that video out to you, make sure to subscribe and click the like button. Otherwise, thanks for watching. I'll see you in the next video.